Hello, welcome back to the continuing lecture series in Principles of Finance. In our last class, we completed the discussion about the free cash flow model. And as at the end, as a ending note, I said the models that you are now seeing, right, and the models that we are using in the present day, all those, discounted cash flow models or dividend discount models were all developed in the 1950s. And then the question is now, so prior to 1950s, how did they price the stocks? How did they value the assets? So specifically pricing the stocks in those days relied on something called price earnings multiple approach, right? Price earnings multiple. First of all, we all know what price earnings ratio is. Price earnings ratio is one of the market stock valuation ratios that have been used very widely and for a long time, even prior to 1950s, right? So that's how they could use price earnings multiple model. And two of the most commonly used valuation ratios are price earnings ratio and market price to book value ratio. And basically price earnings ratio is an indicator of how expensive, how costly, or how inexpensive the stock is for its earnings power. Whereas the market price to book value ratio is generally used as a measure of whether the market price is overvalued or undervalued, right? Compared to the book value. So price earnings ratio is basically, the ratio between the market price and earnings per share. Okay. So let me switch to the whiteboard, right? Okay, I switch to whiteboard and let's think about it. So what does P ratio mean? Price earnings ratio is literally market price. Price means market price, and earnings per share. And we know what earnings per share is. Earnings per share is basically EAT, right? Or net profit, earnings after taxes, divided by number of shares. Okay? And then, so if you think about it, if earnings, let's think about it. If the price is $200, right? Market price, $200. And the earnings per share is $2, right? The ratio will be 100, right? But what does this mean? You can tell easily that if this is the case, that means you have to pay $200 to buy this stock. But then, the earnings per share at the end of the year is only $2. So what does this mean? Obviously, it's a very pricey stock, isn't it right? You would prefer, if possible, if it is possible, you would like, if price is like $200, wouldn't you want a stock that would pay like, $50 earnings, right? If it is paying $50 earnings, what is the ratio? 4, right? I mean, you pay $200 for the stock, and if the earnings per share is $50, then you would prefer, I mean, between these two stocks, which one would you prefer? Hmm? Suppose this is, company A, uh, earnings per share of company A, price earnings ratio of company A, and price earnings ratio of company B. Which one would you prefer? I would prefer this, right? I would prefer definitely company B, right? So you can easily come to a conclusion that the lower the price earnings ratio, the better it is, right? Uh, Actually, there are two camps, right? There are two um, camps in academia that are uh, kind of contradictory. I mean, or conflicting uh, with each other. I mean, of course, that means the proponents of low price earnings ratio and the proponents of high price earnings ratio, right? Even in academia. Why? Um, First of all, let me flip it around. For example, um, if you look at the structure of the price earnings ratio, um, you can tell that this is the output, right? Price is the not the output, that's the input, right? And then earnings per share, that's the output, isn't that right? Or yeah, because you have to uh, put in $200, and then it puts out $50 or $2. That's the output. Then naturally, it seems more natural and it seems more intuitive um, when you look at, actually, if you're comparing input to output, right? I've been talking about this a lot. Um, More logical and more natural way of looking at it is output to input ratio. And we've been talking about this a lot as well, right? In the risk and return, remember when we did, mean variance ratio, right? And the reciprocal of mean variance ratio is called coefficient of variation, right? And I compared, mean variance ratio as the U.S. gas mileage because gas mileage is, how many miles per gallon, right? So output to input ratio is, uh, more natural way of uh, measuring the productivity or efficiency, right? Um, but I also said, in most other countries, they use the inverse gas mileage. In other words, they use input to output ratio. Um, why? Um, if you use inverse gas mileage, what does that mean? Um, be Because it's like how many liters per 100 kilometers, right? The lower the number, the better it is, right? Because the lower the number, that means the automobile is more fuel efficient. So just like that, you can have both uh, U.S. gas mileage, which is output to input ratio, or the rest of the world gas mileage, which is input to output ratio. So price earnings ratio is in term by structure, it's input to output. So if we flip it, then it's going to be what? The reciprocal of price earnings ratio is then earnings price ratio, right? Earnings price ratio. Isn't it right? And the earning actually, so earnings price ratio is then exactly like US gas mileage, right? It's like, mean variance ratio. It's, output to input. And if that is the case, then think about it. If we flip it around, company B would be $50 earnings, right? Company B's case, right? $50 earnings for $200 cost, right? Or input. So in this case, it's going to be 1/4 or 0.25, right? 0.25. And company A price earnings price ratio of company A will be $2 over $200. So this is going to be 1/100, right? Which is just 1%, right? Or 0.01, right? 0.01. Now then, what do you? What can you tell? If we use earnings price ratio, then the higher the number, the better it is. Of course, U.S. gas mileage. Look at the gas mileage. The higher the number, the better it is. The higher the fuel economy, right? Now, but then the name actually, this can be called earnings price ratio, but there is another name. This is called commonly, more conventionally, it's called earnings yield. Okay, earnings yield. Okay, earnings yield is the name. Okay, now, so because earnings yield came up, right? Now let's think about it. There are, this is called earnings yield, right? But then what should this be called? What is this called? That's called dividend yield, right? Dividend yield, right? It's basically, return measured by dividend. This is return measured by earnings per share, earnings, right? And then the difference between dividend and earnings per share. Dividend is only a fraction of earnings per share that is paid out to the investors, right? And now as we came to this, annual coupon payment divided by price, right? Of course, this is bond, right? Because we're talking about coupon divided by the bond price. What's that called? This is called earnings yield. This is called dividend yield. And this is called what? Right? Called earnings yield, dividend yield, right? It's hard to write it, but earnings yield, dividend yield, and then what is this called? Annual coupon over price of the bond. You forgot already? That's called current yield. Remember that? Current yield. right? Current yield, right? Now, interesting thing is, now let's get back to the discussion of, price earnings ratio. So let me, everyone is okay with this. Let me clear that. And so, as I said, uh, although there's, earnings yield, earnings price ratio, but, it's more conventional to use price earnings ratio, right? And then, as I said, in academia, there are two camps. The proponents of low price earnings ratio, which makes more sense, more intuitive, and but there is another, the other camp uh, prefers high price earnings ratio. And why? It defies, all, uh, common sense and logic. Why would you want, high price earnings ratio? If it is, only like, price is $200, but the if it gives only like a $10 earnings, then isn't such a stock overvalued, right? It looks more like, it looks overvalued. It's, quite pricey. In other words, it looks like there's a lot of bubble. For the earnings power, if the price is that high, it looks like there's a lot of bubble built into the price, right? Uh, but then in academia, they call it, uh, now think about it. What they are saying is, even if the earnings per share is so little, the fact that the price is still supported, that high price of $200 is still supported, um, simply means that there is, um, the demand. If what supports the high price is the strong demand, isn't it right? Strong demand, and if there's strong demand is, um, there's a good reason for that strong demand. That's what they are, basically arguing, uh, and that strong demand is due to what? Uh, well, it's called, there is strong demand still supporting that high price. Uh, it's all because of present value of growth opportunity. Present value of growth opportunity, and what that means is, although this company is making so much, profit right now, but it's got a huge growth potential, right? That's uh, uh, everyday's language, growth potential, right? Huge growth potential. So huge growth potential is supporting this high stock price, and because of that, the present value, the price is basically reflecting the present value of growth opportunity, right? It's not bubble, it's present value of growth opportunity. That's what they say. But then our next question is, how do you know there is, present value of growth opportunity is simply the uh, mathematically, actually, it's the difference between uh, uh, in the valuation. In the valuation model, it's the difference between, not paying any dividend, uh, I mean, not having any retained earnings. And think about it. What is the earnings per share for? The earnings per share is actually, if the company doesn't pay out any dividend, right? The entire earnings after taxes, is all reinvested, right? Makes sense? So a company that's not paying out any dividend, although it has, huge, EAT, what do they do with that huge EAT? Basically, it's supposed to be um, plowed back, plowed back into the company, meaning, it gets reinvested for the growth of the company, right? Um, and the between a company that pays out their entire earnings as dividend, right? If think about it, earnings belong to the owners of the company, right? Shareholders. So although the company does normally don't pay out the earnings, right? They reinvest it. But if the company pays out all of those earnings, then what does that mean? The company has no growth potential at all, right? Uh, so between a company that has zero growth potential, a company with zero growth potential, or a company that has zero present whose present value of growth opportunity is zero, which pays out all of its earnings, and the company that doesn't pay out any of its earnings but retains all of its earnings and reinvests it. The difference between those two companies, right? I mean, the price of the company that pays out everything, uh, pays out all the earnings to the shareholders. That company has zero growth potential, so its future value, I mean, a price at time t plus one, what's it going to be? Price at time t plus one will be equal to price at time t, right? Because there's no growth potential. But if the company retains all the earnings, right, and reinvests, then that means price at time t plus one will be greater than price at time t. Make sense? So that is basically the present value of growth opportunity. Uh, the difference between uh, price at time t plus one of a company that pays out everything, all the earnings to the shareholders, and the company B, price at time t plus one of the company B that doesn't pay out anything but retains all the earnings. Then company B has a high growth potential, and the difference between these two companies, right? Uh, let's say their price at time t was the same and earnings was the same, right? The difference between the two is exactly the present value of the growth opportunity, right? So what they are saying is the proponents of high price earnings ratio camp, what they are arguing is that uh, this high price is supported because of the strong demand, and strong demand pushes up the price, right? So the price will be over exaggerated for its actual earnings, and it's only natural. And even if, I mean, if the price is, even that exaggerated, but still investors are buying that stock because they believe in the present value of growth opportunity. That's what that's their argument. But then still, the question doesn't leave me. So what is the question? Question is, okay, how do you know? I mean, although it's nice to call it present value of growth potential, but in other words, there's growth potential, right? Present value of growth opportunity. In other words, is growth potential. But what is potential? Potential is nothing but, I mean, if it realizes, right? In other words, if the growth realizes, and actually, growth comes into fruition, right? Actually, it bears fruit, and then that's good, right? Then there's a solid basis behind that belief that this company has high growth potential. But what if it flops? Actually, there are many, like, pharmaceutical companies, there are many names that are coming up, during the period of, during this time, of COVID-19, companies that are developing vaccine, Gilead, Moderna, or, there are several companies whose names really emerged because of their R&D in COVID-19 vaccine, and their prices went up a lot. But then, think about it. If their vaccine gets approved by FDA or CDC, then the growth potential will come true, right? That it will be fulfilled, it will be realized. But what if even after our very extensive research for 1 year, 1 year and a half, their product doesn't meet the criteria, and then they don't get approved by FDA or CDC, then what happens? That growth potential turns into nothing. It's just everything that was feeding into the stock price was nothing but bubble, right? So, in other words, there are two possibilities, take off, success, right? And take off, right? The new product, actually, becomes very successful and it takes off, or flop, right? So, in other words, we don't know if it is, this present value of growth opportunity is, how solid it is, how solid it may be, and actually, what's supporting the high price earnings ratio? Maybe nothing but bubble. Of course, we can try to find probabilities and calculate probabilities and assign the probabilities there. For example, if the probabilities of takeoff success is higher, like 80%, flop 20%, expected the expected value would be still positive, right? Then low price earnings ratio is relatively quite solid, right? We understand why low price earnings ratio is preferred, because of solid evidence. It was solid evidence that the earnings power is great for its price. But then the question is, and also the critique from the high price earnings ratio camp, the critique, right, is that the look, if there is if the price earnings ratio is low, that means for the earnings power, the stock is undervalued, right? If it gives you so much earnings per share, then shouldn't the price jump? Shouldn't the price go up? Why? Everybody would want that stock. So the demand, there will be huge demand, and strong demand will push up the price. Yeah, that is quite valid criticism, right? Because valid criticism, because if the so it's a question of how long does the window of opportunity remain open, right? if you've been hunting for these, low price earnings ratio stocks, and you found it, and if you could find it, right, through research, right, of course it's very labor, it would be labor intensive because you have to go through a lot of stocks, right? It's not like you have to first shortlist it out of candidates. Let's say S&P 5, anything in S&P 500 has been well researched, right? It would be difficult to have, but so relatively less known stocks in the Russell 4000 or so. And then if you identify, you have to shortlist a few of them. You go through like thousands of stocks and shortlist down to like something like 100, and then stacked up in the order of earnings power, price earnings ratio, and go let's say shortlist it to the final list of 10. But then when you are putting, you found 10 of them, the best performance, right? The lowest, price earnings ratio. And by the time you put money in them, others would have also discovered those 10 stocks, and they also put money, pour their money into those stocks. Then sooner or later, what's going to happen? The price will go up. And as the price goes up, then the window closes, right? So the question is how fast you discover these stocks before anybody else, before the window is, while the window is still open, and you put the money into that, and the late arrivals will, for the late arrivals, window will close, the entrance will be very small, and then when everybody puts their money in, price goes up. Then, if you're the first comer, you make money, right? But once again, the critique from the high price earnings ratio camp is that saying that these days, with a lot of information, a lot of effective way of collecting information, most likely the window wouldn't remain open for a long time, and that is quite plausible. That's so they are both, they have critiqued each other. Both camps have critiqued, each other, and but so far, empirical results, empirical results. So the low price earnings ratio speaks for itself through empirical results, because the champion or the figurehead of this camp, low price earnings camp, is none other than Warren Buffett, right? Warren Buffett's strategy is basically identifying the undervalued stock, low price earnings ratio stock, and invest in it. So, and also there's a supplemental method of verifying whether this high price earnings ratio is solid or nothing but bubble, and that, which is that verification method is called price earnings growth ratio. Okay, so I'm going to come back to price earnings growth. Okay, let me explain quickly. We have a little time, but so price earnings growth ratio is what? Price earnings growth ratio is basically price earnings ratio over earnings growth ratio. Earnings growth ratio, right? And if this number is close to 1, if this ratio is close to 1, then that high price earnings ratio is justified. So what does that mean? Suppose price earnings ratio is 100, right? Price earnings ratio is 100. So earnings ratio of 100 is, very expensive stock. Why? If you pay $100 for that stock, all you get in earnings is only $1, right? That's what price earnings ratio, P ratio of 100 means. If it is $200 stock, the earnings per share is only like $2. $1,000 stock, a $500 stock, price earnings ratio of 100, right? For a $1,000 stock, the earnings per share is $10, right? That's what it means. But if this high price earnings ratio for the stock with this high price earnings ratio, if the earnings growth rate, suppose the earnings growth rate is 100%, what does that mean? If annual earnings growth is 100%, that means this company's profit is doubling every year. Make sense? If the company's profit is doubling every year, what would be the demand for such a company? It goes without saying the demand would be very, very high, right? I would definitely want to put my money into a company whose earnings growth rate is 100% a year, right? And then high price earnings ratio of 100 is justified. It's well supported. I mean, the number may not be exactly, and ignore this percentage, right? Because when you take this ratio for this to become 1, you'll have to ignore that percentage, right? Because 100% is only 1, right? So if this ratio is, but it may not be exactly 1, but if it is close to 1, if it is roughly, right, close to 1, that means that high price earnings ratio is well justified. Okay? All righty. So then that explains what, P ratio and what P ratio does to the confirm whether high price earnings ratio is validated or not. Now, so let me erase. So back to the price earnings multiple. So price earnings, the price earnings multiple technique is basically a stock valuation pricing technique, and then what it is telling you is that the price of the stock is price earnings ratio times earnings per share. Okay, earnings per share. But then, some of you may have already discovered something weird about this. Why? Isn't that like, isn't it a tautology? Tautology is a statement that is always true because it's, referring back to itself. Why? Look, what is this? Price earnings ratio is basically market price over earnings per share, right? So then if you multiply that by earnings per share, what happens? Earnings per share cancels out with earnings per share, both, gets canceled out. It cancels out itself, right? Then, by definition, what does that mean? Then price is price. Market price is, but, what this means is this is what? This is the market price, right? Do we want to know the market price? I mean, are we calculating the market price? No, I've been telling you, market price is not something you calculate. Market price is the data in the market. I mean, the market's trading data is there. You can always retrieve that you can look up the market trading data. The most today's end of today, right? Closing at the end of the today's trading, the closing price of the today's day's trading is today's price. Or at any point, during the day, at 2 o'clock, you check the price, and the most recent trading, most recent price is there. So it's not the market price that we are trying to solve for. It's what we are trying to solve for is the intrinsic value. Remember that intrinsic value, right? So then, if this formula, this price earnings ratio, is like a nonsense, because it looks like a nonsense because earnings per share cancels out each other, and then you're left with the market price, then that simply means price is market price. I mean, what's the point then? You didn't get the intrinsic value, right? So actually, this is a misunderstanding. Why? So what they are trying to find is, okay, let's call that stock price of company X. Okay, stock price of company X is the price earnings ratio of the industry price earnings ratio. In other words, industry average, right? Industry average price earnings ratio of industry times earnings per share of company X, right? So think about it. This earnings per share and this earnings per share won't cancel out because they are not the same earnings. This is the average earnings per share for the industry. I mean, this ratio is basically the ratio of the industry. So if you think about it, the reasoning behind this formula is that so company X made like $50, $20, let's say $20 earnings per share, right? The most recent earnings per share of company X was $20. Market price would be something, $100 or whatever. And but through the lens, on average, this industry's price earnings ratio is 15, right? On average, price earnings ratio of this industry is 15. Then, based on or compared to the extrapolating on the from the industry average price earnings ratio, what would be the rationally expected, right? Most reasonably, rather than rational, most reasonably expected price from the through the lens of this industry. Through the lens of this industry, what would be the most likely price, right? Right? Considering industry average price earnings ratio of 15, what would be the most likeliest price? And the most likeliest price, or most likely or likeliest price, would be then $20 times 15, and it's going to be $300. Okay, and that is the fair value, seen through the lens of the industry, right? And if the market price is let's say 310, Okay, what can you say about this company or about this stock? You can say this stock is overvalued. Why? This is the most, reasonably inferred price through the lens of the uh, industry average price earnings ratio, right? But the market is pricing it higher than its fair value. So the stock is, this is the market price, this is the price that it should be. So it is overvalued. Or you can say, what if it is 290? Of course, you can say then the stock is undervalued. Okay. Now, then the question is, yeah, this is how they did it prior to 1950s. Okay. Uh, Although this is an old, technique, right? They still use this widely because, for people who didn't have a formal training in finance, right? They don't know anything about discounted cash flow model. They don't know anything about the risk, right? They don't know anything about, a statistical method of, measuring risk, mean variance ratio. They don't know anything about that, right? But price earnings ratio is relatively easier to understand. I mean, without too much, without that too much training, still they can understand uh, the rationale behind price earnings ratio, right? But then the downside of this price earnings multiple method is that the um, it's not accurate. It's not exact science, right? Why? Um, it's just a rule of thumb because if you're valuing the stock through the lens of the industry, average industry, I mean, within the same industry, so many there are so many different firms. Although they are in the same industry, each firm would have different risks, right? So this company X would have a different risk from company Y or company Z, company A, company. So there is nothing in this model that would make adjustment for the risk that specific risk that this company X is faced with, right? Get that? So uh, it's not very modern, right? Technique, one, the first downside. Two, most critically, right? It's lacking uh, risk adjustment, right? It's not risk adjusted. So, which would then result in um, uh, inaccuracy, right? Imprecision, right? So, it's not exact science. And that's the downside of price earnings multiple approach, right? So okay, so this wraps up everything about the stock valuation, uh, and as I said before, we had a further advanced um, material in risk and return, and I said we would have to come back to that later after finishing the stock valuation. So in our next class, uh, we're going to be resuming. We're going to go back to where we left off in the risk and return topic, right? In that slide, we're going to pick up from where we left off. Okay, so that will be our next topic. Thanks for watching, and I'll see you in the next class. Okay, stop recording.